Schedule D is a common form to see in your tax return if you have an investment account, like a TD Ameritrade, Robinhood, or Schwab brokerage account. Schedule D is where you report capital gains or losses from the sale of assets. Whether those assets are stocks, baseball cards, cryptocurrency, or your primary residence, all of those items are summarized on Schedule D. There are two main sections based on whether the purchase and sale of the asset was under a year or over a year. If you purchase a stock in March and sold it 60 days later in May, that's a short-term sale. And that sale is taxed at ordinary income tax rates. So the tax on that sale depends on where your AGI lands in that particular year. But if you waited until the following year in June to sell the asset, about 15 months after you purchased it, that's a long-term sale. A long-term capital gain is taxed at much more favorable rates. It also depends on your total AGI, but the max is 20%. So that's at least a 10% tax savings, if not more. And depending on the circumstances, your tolerance for risk, and your prediction of the value of the asset you're selling, it can often be very advantageous to hang on to that asset until 366 days after you purchased it, because it really can save you a ton of taxes just by ensuring you're in long-term gain territory. Unfortunately, the IRS doesn't allow you to take full advantage of your mistakes when you sell an asset at a loss. Whether it's a short-term or long-term loss, the IRS only lets you deduct $3,000 per year if you don't have the gains to offset the loss. So if you put in $30,000 to a stock that eventually went bankrupt and you were left with nothing, you can only reduce your taxable income by $3,000 per year for the next 10 years. You're not allowed to reduce your taxable income by the $30,000 in the year that you found out your investment was worthless. Now, depending on how many mistakes like this you've had, these can often be carried over for more than 10 years. But usually, there are enough gains in future years to offset the loss instead. Now, the last item of note is the sale of your primary residence. You'll notice column G on Schedule D is for adjustments. And as long as you owned your house and lived there for 2 of the last 5 years from the date of the sale, you're able to exclude a portion of that home sale from your taxable gains. If you're single, you can exclude the first $250,000 of gains on the sale of your primary residence. If you're married, that gets increased to $500,000. So if you're single and just sold the first house that you bought after owning it for only 3 years, even if you sold it for $185,000 profit from what you bought it for, that gain is entirely excluded because it's under the $250,000 limit. So that $185,000 is not taxable. And then when you buy your next house, the clock resets and you can do it all over again. This is a major area to benefit from in the tax code.